All right, everybody, welcome back on the 8th class. Okay, today we're gonna wrap it up the laws, right? All the mortgage law, and so believe it or not, we're already on the 8th session already, right? For the next for the next several classes, I will probably gonna go dive in deep with the activity of an MLO. Probably give you some example. Um, I'm actually right now practicing MLO, so I can consider myself a professional now. I had my license like over a year, but I never practiced. But now I already registered with a broker, and I working as a loan originator. So I can give you some demo, within the next several classes as well. In the past, I actually invite many professionals that came to the class and then give some lecture. If you want to go back to the previous year videos, then you're probably going to see a lot of demo from the professional MLO. That way you can learn from them too, right? So because I already had that, so this class, I don't invite anybody into the class, okay? But I will probably gonna help you, guide you through not only practicing for the test, but also practicing for becoming an MLO as well. Okay, so same thing. This real estate landscape still the same. Yeah, nothing changed since the last time we saw it. Okay, if you want to understand what these figures are and how they associate with each other, go back to the first and second class. You're probably gonna see it again how I explain it. Okay, so similarly, this is a list of all the regulations. And today class, there's a law, an act that was introduced in 1933, and it was in the Great Depression, right? Because of that, they keep introducing new law every year. We're in the 2024 right now. Probably, we're gonna see some new law as well. 2023 or 2024, laws are gonna come out. Okay, so this list is gonna keep growing. It never stops. Okay, so like I just mentioned, earlier, that back in 1933, there was a law that introduced, which is called Glass-Steagall Act, and this act or this law was a landmark. At that time, it's an act during the Great Depression in response to the financial turmoil of the era. Right, it aimed to address several conflicts of interest and some risky financial practices back then. Okay, and back in 1930, probably early 33 or 32. I don't remember exactly, but I think it's probably in the 1933 that it's similar to like 2008, right? But this is even worse. Okay, so at that time they introduced like so many laws because there no regulation, no oversight, nothing at all, right? So that's why it was like a big impact on the economy as well as the banking, financial institutions, financial industry, I should say, and also housing. Okay, so that's why they enact this law back in 1933. The first thing that the reason is that they want to do this because they want to separate the commercial banking with investment banking. Okay, commercial banking meaning that we, as a retailers, we are mom and pop, right? We go to the bank, we put the money into the bank, right? And then we may have a checking, we may have a saving, right? And we may borrow money and we may pay back, right? So it's a lot of that's involved in commercial banking. And then guess what? The deposit that we put in, the banks, they take it out and they go and reinvest somewhere else, right? And then by doing that, they back then there's not a lot of regulation, so there's no oversight, there's no control, there was no control. So they invest in like really risky asset, and when everything boom, bust, right? And then all the money that we put it in, got used somewhere else, and then we never could see it again. And that's that's a whole big issue. Back in the early 1930. Okay. So it says right here that commercial banks were primarily engaged in traditional banking activities, just such as accepting deposit and making loans, while investment banks engage in underwriting security, trading stock and bonds, and other speculative activities, right? So the act was trying to prevent commercial banks from engaging in riskier investment. Okay, so that was the goal for enact the Glass-Steagall Act. Prohibition and affiliation. The act prohibit commercial bank from affiliating with company engaged in security trading and underwriting. So what this means is that if there's a commercial bank, right, either the bank that regulated by federal credit union or private bank, right, the act say that you cannot have an affiliate with any trading company, okay, or a company that underwriting risky loan or whatever, okay. So this act prohibits that, okay. And the goal is that it tries to prevent the conflict of interest, right? And also like self-building by bank that might lead to risky investment and misallocation of the fund, okay. And also, this act, this is called a Banking Act of 1933, and this act is actually the act that create the FDIC, which is stand for Federal Deposit Insurance Corporation. If you go to any bank, right, you're probably gonna see a little sign, at the bank counter. It say FDIC, right, and it is stand for Federal Deposit Insurance Corporation. What it means is that any money that you put in the bank nowadays, right, is actually got protected, or there's an insurance, insure of the amount that you put in. But guess what? They only insure per account, per bank, up to $250,000. Okay, so meaning that now that if you have $1 million and you put in one bank, right, and then that bank get bankruptcy, right? This division, this insure division, the Federal Insure Division, FDIC, will guarantee that you only lost $750,000, and you're gonna take back $250,000, right? So FDIC kind of insure your money that you put in the bank. So if you're smart enough, right, you don't put all your eggs in one basket. Then you have to spread it out to multiple banks, right? If you have $1 million, good idea that you spread it out to four different banks, right? So that your money is protected because they only insure up to $250,000. Okay. Regulation of security and activities, right? The act imposed regulations on the activity of investment bank and security firm to ensure transparency and fairness in the issuing and trading of securities, right? So the act say that if you are investment bank or you are a firm that trading stock, bond, equity, or whatever, right? You need to be fair and you need to be transparent of what you do. Okay, so meaning no illegal activities. Okay, and everything need to be disclosed, to the whenever the federal agency is asking for it. Also, regulation of security offering. Glass-Steagall require the registration and regulation of security offering, helping to establish more rigorous standards for public offering and investor protection. Okay, so meaning that if you're a company, you go public, you IPO, you want to offer stock, you want to offer different kind of securities, right? You need to first register, meet all the requirement of the federal FDIC, and then you have to follow all the guidelines, standards, and all that, right? Before you put you're offering your investment to the investors, the public investors. So that way, whoever want to invest in your company know exactly who you are. Even sometimes that your company may do well or may not do well. They may make money or they may lose money, but at least, to the minimum, you have to, you have to disclose and make sure everything is transparent. Okay. The most significant change came, with the Graham-Lee, Beverly Act of 1999. It's actually an amendment to this 1933 Act, and we're gonna talk about it in the next few slides. Okay, the Graham-Lee Act, which is called GLBA of 1999, it's actually repealed some of the provision of the Glass-Steagall and allow a combination of commercial and investment banking activity under certain conditions. So meaning that now we are mature, right? Technology is better. There's better regulation. There's better laws, and there's better procedure, guideline, standards, and all that combined. So now they allow the banking to do, the banking to do both commercial and investment. Okay. And we will know about that in a bit. So the Banking Act of 1933 is mainly try to prevent a conflict of interest, right? Reduce the risky speculation investments, and also try to prevent bank failures, right? During the Great Depression, we witnessed a wave of bank failure and financial panic. So when there's a financial panic, right, people are gonna go into the bank and withdraw all the money, and the bank doesn't have money to liquidate or to be able to pay back the depositors, right? So that's why they probably go bust, they go bankruptcy, then we don't have money to put back because all the money that we put in investment unable to liquidate it, and when the market fluctuate, all those investments also lose money too. Okay. Also, this act is need for investor protection, right? There was a lack of regulation and oversight back then, right? The regulation in the security markets leading to fraudulent practices and inadequate investor protection. The Glass-Steagall Act sought to address these issues by imposing regulation on security offering and trading. So it's kind of interesting when we read this, right? Back then, 1933, right? Because there's not a lot of regulation, and that's why the financial industry crashed, right? And guess what? 2008 is happening again. So if you take that into account, so how long is that? It's probably 75 years. Let me see, 2008, yeah, almost like 90 years, almost 100 years, right? Let me see if my calculator is right. 08, that's 70 years, roughly, right? Roughly 70 years. So meaning that, does that mean that 2008 just happened? Are we gonna wait another 70 years before something else happened, right? Back in 1933, right? People probably think that all the financial institution CEOs, regulators, SEC, FTC, probably they are good people, they are knowledgeable people, right? And they still make the market crash back in 1933. And we think that we better, right? So 2008, everybody think that we better, we know more. It's almost 100 years, right? We know much more. And guess what? The market crashed again, right? Crashed a big time. So I even watched a video that Alan Greenspan, was testifying with Congress, and he did also admitted that we didn't know. Okay, so meaning that at any certain time, in history, right, whenever something happened, meaning that we didn't know. Obviously, yes, because we didn't know, and maybe sometimes greed and all that, does play, in the picture as well. But like I say, things will be happen again. Okay, it's happened in 1933. It's happened in 2008. It will happen again. Just when it happens, we will see. Okay. So again, right? 1999, a new act came out. It's the GLBA, Graham-Lee Act. It is Regulation P. Right. The GLBA is also known as Financial Services Modernization Act. So meaning that they wanna rewrite whatever in the the Banking Act in 1933 and add some some protection, some regulation, some procedures, as well as open up like more ways to to do banking, so that they don't restrict the the commercial bank for not doing trading. So probably right nowadays you're probably going to see that Bank of America, right, they do have like a division that do lending, a division that do investment, a division that do stock trading and all that too. Okay, so because of this act, commercial banking are allowed to do that too. Okay, and let me see, it is a U.S. federal law that fundamentally changed the regulatory framework governing the financial services industry. It was signed into law by President Bill Clinton, okay, November 12, 1999. So if you heard, if you in the past, if you hear about TLBA, 1989, and it's probably asked you which president signed this bill into law. Probably if you don't remember it's Bill Clinton, at least if you see like Bill Clinton, Barack Obama, President Trump, or which president is that? Let me see. President Bush, right? And you know that at least the right answer would be President Clinton or President Bush, right? But Clinton is probably before Bush, so your guess is that 50-50, right? So you should pick the one that have an earlier presidency, so which is President Bill Clinton. And I don't see a lot of questions in the test that mention about the exact date. Okay, let's say, okay, so when did President Bill Clinton sign this TLBA law into law? Is it November 12, 1999, November 13, 1999, or something like that? I don't think that it's too that specific. Maybe if it's asked, it may be the year is is at least. Okay, so like I said, the primary objective of this act is to promote competition among financial institutions while protecting the privacy and security of consumer personal information. Okay, so meaning that this act, the TLBA Act, was an act so that it's promoting a way so that financial institutions like have a chance to compete one another. That way it will provide better services, maybe lower cost, right? And this act also introduced like new law, new rules that need to protect the personal finance information, right? And like I say, this act was allowed that commercial banking be also an investment banking and also an insurance activity company as well. Okay. So here, additional some of the objective is the financial services integration, right? So meaning that it's remove the barrier, from the 1933. So now you can become a commercial, investment, and insurance all in one. Okay, or any combination. Privacy provision, right? The act introduced an important privacy provision that require financial institutions to establish privacy policy and practices, right? Notify consumer about their privacy rights, okay? And allow consumer to opt out of having their non-public personal information from sharing with any, non-affiliated third parties. Okay, so this act, this GLBA Act, remember, GLBA is just an amended act from the Banking Act 1933, but also add on. Okay, it's allowed do multiple investment type, but it's also add on the privacy protection for the consumer. Okay, remember that privacy protection for the consumer, which is the GLBA. And I think the name for the act was because there is a senator that introduced this act, so they took his name as for the act. Okay, and additionally, it's also required that the bank need to safeguarding consumer information. Okay, not sharing, but also safeguarding as well. Okay, they can share it within their affiliated, but they cannot share with non-affiliated. But if you want to share within your affiliated meaning that the bank might work with a different division of the bank or with its partners, right? So meaning that they can share the consumer information with those entities, right? But nowadays they have to have consent too, right? Or disclosure. They have to disclose that, okay? But they cannot share with the non-affiliated partners. Okay, financial privacy notices. I just mentioned it, right? So if they share, they have to notice the customer, okay, and explain how they collect, use, and share customer information, and how customer can opt out of certain information sharing practices. So if we are consumer, right? The bank say, hey, we have a list of things that we do, right? Read it, right? Because like we're gonna share your information with our partners, our affiliate, right? You read it. If you don't like it, then no, I don't want you to do this. I don't want you to do this. I don't want you to do everything. Okay, all of it. Okay, so now we have the power to prevent the bank from doing that. But the thing is that if you want to go out and you want to borrow a loan, and then you don't want the bank to share your loan information to different division of its company, then they say we cannot do the work and we cannot get your loan and we cannot approve you for a loan. So now we have to ease the requirement a little bit so that they can at least do the job to serve you. Okay, pretext and prohibition. The act makes it illegal to engage in pretexting, which involves obtaining someone's personal financial information through false pretense, fraudulent statement, or impersonation. So meaning that you cannot pretexting meaning that you want to pretend like you are someone, okay, or you provide like false information, false data, even fraudulent your activity as well, right? So this act prohibits that. Okay. One example that we can say is that if we say that we're gonna borrow a loan for a primary home, okay, but end up we never live in that home, that's the fraudulent. Okay, so be careful on that one. And a lot of people are doing that. They may say, I live in there for a couple of months, I rent it out. That's my investment property. That's fine too. But in the mortgage application, there is a form that say that you claim this as your primary home, so you must live in here maybe 3 or 6 months. Okay, but the thing is that life change, right? If you lost a job, right? If your daughter or son moved to a different school that you need to move, right? You need to rent it out. It's happened. Okay, so there's a lot of justification of what you do the way you do. Okay, but at least don't do the fraudulent way. Okay, so this act also put in like enforcement, okay, to the the banking institutions, right? Various federal agencies such as the FTC or Federal Trade Commission and federal banking regulators have enforcement authority over the TLBA compliance. Violation of the act provision can result in civil penalties and regulatory actions. Okay, so this is the FTC, right? And also some of the federal banking regulator have the authority to control, to to monitor and to overlook up all the activity, including the activity of the banks, as well as the activities of the consumer as well. So not only that the bank is violation, but the consumer, if you get violation, you probably also get prosecuted as well. Okay, here are some exceptions and exemptions of the TLBA. Okay, TLBA includes certain exceptions and exemptions, particularly for smaller financial institutions and specific types of information sharing. Okay, so meaning that if you're a big bank, you have to follow the TLBA. But if you're like a smaller financial institution, probably there's something in the in the activity that you get exempt and you don't have to follow. Okay, and also sometimes that there's certain information that doesn't need to be get consent even if they sharing your information. Okay, so the Graham-Leach-Blackley Act requires financial institution companies that offer consumer financial products or services like loans, financial or investment advice, or insurance to explain their information sharing practices. Okay, we talked about this to the customer and also to safeguard the sensitive data. The safeguard rule include the FTC safeguard rule requires cover companies to develop. So the company need to come up with a system, right? How to implement it, how to maintain the data, how to maintain the records, and and also maintain an information security program with administrative, technical, physical safeguard, which is designed to protect the customer information. So nowadays, banking need to up their game with their information system, like like a server, a framework, a computer system, a cloud system. Those need to be secure to protect the consumer information. Okay. Privacy rule and auto dealers. Okay, company arranging in financing or give financial advice must notify customers about the information they collect. Okay, what do you collect? Okay, I collect your address, your phone, your social security number, and who do you share that information with? So the bank needs to disclose that. And how are you going to protect it? Okay, are you following the rule of the road? Okay, so think like that. Privacy rule, sharing rule, and all that need to be in place. Okay, so they need to come up with a system within the company on how to do that, and doesn't violate the law. Financial institution covered by the Graham-Leach-Blackley Act must tell their customer about the information sharing. I think this is just repeated here. Okay, so that was the GLBA. Now, we are moving to the modern world. Everything that we, back in maybe 2019, not even 2019, I would say in the 1990s, 1980, 1990, a lot of paperwork that we do, we are, we actually ink it, right? We have to sign it by ink. And we kill tons of trees, right? But just, print it out, sign it, retain the record, retain the document, store it somewhere, right? But nowadays, we're in the digital world right now, right? Everything is electronic, right? You can send an email, you can send a text, form can be generated, using PDF, right? Word document, right? And then because to facilitate the fast growing technology, right? And they see the use of e-signature, electronic signature is it's better. Okay, it's help moving the the industries fast and forward. Okay, but in order to do so legally, right? Regulator need to come out with an act, so which is called an e-sign act 2000. Okay, the e-sign act say okay. It's facilitate and promote the use of electronic signatures and record an interstate and foreign commerce. E-sign provide a legal framework for the use of electronic signatures and record various transaction, contract, agreement, legal document. So it's actually used in a wide range of business and consumer activities, right? So with the e-signature, if you don't know, that when you sign the e-signature, it also have a certificate come along with the e-signature, right? So that certificate probably gonna be stored by the e-signature software or company, right? Or even if you sign it and you want a certificate of that, you can ask for it too, right? Because when you do an e-signature, right, you just quickly scribbly draw on the document, and then you sign it, you say complete, right? Behind it, on the signature, they also embed an e-sign mark. Say okay, this signature is signed on this date using this tool or software, right? And they also have a tracking record of that activity through a different file, Okay, it's got a certificate of that e-signature. Okay, and if you want to ask for it, you can. So let's say if you don't, and then the e-signature is actually able to store that certificate, and then let's say in the future somebody claim, hey, I didn't sign that, right? That's not my signature. Because like, guess what? When you do this e-signature, you can adopt different way of signing a document. You can just write your name, you can scribble it on the document, right? So meaning that anybody can do that, right? However, right, you sign a consent, an e-signature consent. Secondly, you do the signature signing is store your certificate, right? So if you in the future you come back and you claim that hey, I didn't sign that. They say, hey, we have proof here, we have record here that show that you are the one that signed it. Okay, but majority that when you do e-signature, it just helps and speed up the process. Okay, so just the process. But when we're talking about real document, the document that's going to affect the title, a document that's going to affect your notes. Your note is your promissory note, is the note of paper, a legal paper that say you own this bank, this amount, pay how much, and what interest rate, right? Those documents need to be inked, meaning that you need to be signed with a notary. Okay, so if you look at the diagram that I showed you earlier with the real estate landscape, the notary gonna be the one that's gonna help you with that. And the notary is the certified legal person that gonna verify your driver license, your thumb, they got your thumbprint, they get your signature and all that. And all that is also documented in the system as well. Okay, so that way, real document, legal document need to be inked, not by e-signature. E-signature is just a way to facilitate, right? So that you not because like every document needs a signature, but certain documents can be, easy to to pass on, or just like a record for a bank, right? But doesn't affect anything, right? It's maybe an agreement with the bank, right? So, but eventually the final document need to be, ink. Okay, so the e-sign has some key components, including the legal recognition of electronic signature. Okay, e-sign establishes the electronic signatures are legally equivalent to traditional handwritten signature in most cases. Okay, making electronic signature a valid and enforceable in contracts and agreements. So meaning that even if you do an e-signature, it's a legal document, right? It's enforceable too. Okay, so if you sign it, you are bind to that contract, that whatever say on that paper. Okay. Use of electronic record. The law ensures that electronic records have the same legal status as paper records and can be used to satisfy various statutory requirements. So meaning that we have in the past we have printed out documents. So those documents are legal paper. But nowadays we're using digital file, right? So those are also nowadays, because of this e-sign act, those documents is now legal document too, even though they are electronic, but they are legal document too. Okay. When you use an e-sign, you need to first get a consumer consent. Consumers say that I'm agreed to use e-sign. Okay, meaning I'm legally binding into, first to the e-sign law, secondly to all the contract that I'm going to sign. Okay, transaction records. The act requires party involved in electronic transaction to retain records of those transactions for a period of time. Okay, this helps ensure accountability and transparency in electronic transactions. So all the documents that you sign need to be retained for a specific time. You probably remember I mentioned about the compensation rule, right? 2 years of record, escrow maybe 3 to 5 years, right? So there are a certain period of time that these electronic documents need to be stored and retained. Okay, exception. E-sign includes specific exception for certain type of document and transactions that are excluded from its coverage. such as the will, the trust, family law matters. So you see like these documents here, will, trust, and all that, those need to be inked. Okay, those are not going to be covered by the e-sign law. Okay, preservation of state law. While e-sign provides a federal framework of electronic signature and records, it does not preempt state laws that are consistent with its provisions. State may enact their own electronic signature and records laws, provide they do not contradict the e-sign. Okay, so local government, state government, they may have a different provision to the e-sign law, or maybe there's some document they require, the real signature. And the law require a compliance and with the federal regulations. E-sign does not override other federal laws that may require specific documentation or disclosure in writing. Okay, so like I say, e-sign is just a way of facilitate, but there's a law that everything needs to be in. The problem law say that when you sign a title transfer, when you sign a note, it needs to be inked. Okay, some businesses and organizations must still comply with any applicable federal regulation. All right, the e-sign was signed into law or enacted into law on June 30th, 2000. So when you're talking about e-sign, remember it's introduced in 2000. Not sure everybody remember the year of 2000. Whoever born before the year of 2000. It was an interesting time that they claim at midnight of 11:59 p.m. 1999, December 31st, right? When it hit over 2000, then there's a lot of computer not gonna work. Okay, it's what we call is a Y2K issue, and it's kind of interesting and fun back then, right? So meaning that the clock, the digital time in a computer processor didn't take into account of the 2000. Okay, so maybe when it's reaching, 1999 at midnight, December 31st, it's gonna roll back to 01. Okay, so at that time, this a big thing because it's not only affecting computer, it's affecting like system like power grid, transportation, banking, and all that. And at that time, a lot of company, high-tech company, they put in a patch, to all these computer, all these servers, all these systems to mitigate the issue of Y2K. So it's kind of interesting, but nothing happened. Okay. So let me see. So remember, this act was enacted in 2000. Okay, June 30th. If you want to remember exact date. Okay, consumer must provide affirmative consent. Like I say, when using e-sign, you need to get an ink consent from the client. Okay, you don't get an e-sign consent from the client. Okay, so meaning that if you want the as an MLO, as a lender, right, as a broker, you want to process your loan, the loan transaction, right, and want to use e-sign as a tool to sign these documents, then first you have to send out a packet. Escrow send out a packet, say, okay, I am consent using e-sign for processing document within this escrow. Okay, so that document, that form need to be inked. Okay, you cannot using e-sign to sign the consent form. Okay, retention of contracts and record. If a law requires that a business retain a record of a transaction, the business satisfies the requirement by retaining an electronic record as long as the record first accurately reflects the original document. And also that electronic copy need to be accessible, right? You can easily print it out. You can easily show, you can easily email, okay? And in a form that is capable of being reproduced, okay? Like I just say, print it out and get to it, okay? And also retain for the legally required period of time, okay? Keep that electronic copy for sometime. Okay, so far, anybody have any question? I know that sometimes when I talk a lot, and I talk continuously for a straight hour. So I want to pause a little bit. Anybody have any question? Okay, so these laws are, was enacted just try to facilitate the industry. Okay, because like we are moving in a really high speed technology, right? And now guess what? We even have AI, for our own dispose, right? So there more going to be more laws they're going to introduce in the coming years. Okay, so now we're talking about USA Patriot Act. Okay, what it is? Okay, Patriot Act. When you hear about Patriot Act, remember September 11th. Okay, when you hear the Patriot Act, remember September 11th, because due to the event of September 11th, right? This act was enacted, right? It's a U.S. federal law that was enacted on October 26th, 01, which is the year of September 11th of 01. Okay, in response to the September 11, 2001 terrorist attack in the U.S. The USA Patriot Act was designed to enhance the government's ability to prevent and investigate acts of terrorism, improve national security, and strengthen law enforcement tools in the fight against terrorism and other related, domestic crimes. You probably remember the act that I mentioned about money laundering, right? The BSALM, something like that, right? That money laundering is also try to preventing, financially supporting the terrorist, terrorist groups, right? So the Patriot Act, enhanced by adding, a couple of provision or components, which include enhance the civilian. The act expand the authority of the law enforcement agency to conduct electronic surveillance. So probably, in the US, everything we do talking about privacy. Now, due to the fact that September 11, right, the government want to use surveillance to survey like all the city, road, shopping mall and all that, right? Now, this act allow them to do that. Before this act, right, anything that you use need to get the consent from the person that appear on that particular media or video, right? But this act saying, okay, the act allowing the government agency to use all these pre-recorded surveillance, media to help, preventing, terrorist attacks. Okay, it allows collection of wider range of communication and records. So meaning it's not only collecting your video feed, it can now also, if they want, they can surveillance your email, your social media posts, anything electronically. Okay, so and also information sharing. The USA Patriot Act facilitated sharing of information between different government agencies and intelligence community to improve the identification and tracking of potential threats. Okay, so now government, due to this act, they have a wider authority, wider range of accessing to the data to to tracking and preventing any potential threat to the nation. Okay, financial investigation, right? We're talking about the money laundering, right? So now this act provide law enforcement with tools to investigate and disrupt the financing of terrorist activities, including provision related to anti-money laundering and monitoring of financial transactions. So you may now aware that money that transfer between country to country or from different country to the US, they're gonna monitor it. And over the time, they keep reducing the amount that can be transferred over from one foreign account to a domestic account. And even they can, probably gonna ask why you got this transfer, the purpose of it, right? And why this amount, right? You need to be able to provide an explanation, okay? And make sure the money that you transfer over is legit. First, it needs to come from a legit source. Second, it needs to come for a legit purpose, right? The money that where it's come from need to be proven, and the money that's gonna put into the destination or destination account, right? You need to say what you're gonna do with that, right? And they can also monitor that. And we also talking about the I forgot the act name, but the act say that anything, or the SAR report, right? Suspicious activity report, right? We talked about that in one of the acts, and it say that if the bank see you have a $10,000 or more, they have to write a record of that, reporting that every month or every quarter, right? Or instantly, to the authority, right? So we talk about this, right? So this act also in play with that. If you have 50,000 in your bank account, there will be a record on that report that the bank reported to the authority, to the IRS, to the FTC, to the SEC, right? A lot of interesting stuff, right? Okay, and this act also will enact a provision for roving wiretap. The act allows for the use of roving wiretap with authority, which authorize law enforcement to intercept communication on a telephone line, on a communication device, right? On your chat, on your Zoom, or whatever. Maybe somebody is monitoring what do we do right now. We do good stuff, so don't worry. Okay. So meaning that this law, USA Patriot Act, now tap into our daily routine, right? That our daily activities, and they authorize now. Yep. What we do and like illegal, they can track this. They can get this kind of record, and then they kind of come after us if we do something illegally. Okay. So meaning that be careful when you go doing business out there, right? Try not to do illegal stuff, because guess what? All these law provide the tools and and things like that for the government to keep track, right? To prevent and to enforce, right? So always do the right thing. Okay, Foreign Intelligence Surveillance Act, FISA amendment. So there's an amendment to the USA Patriot Act. It's called FISA, right? FISA is amended to expand the scope of surveillance activities for foreign intelligence purposes. Okay, so there may be some cooperation between our government and foreign government, vice versa, right? So the U.S. government may be cooperate to help the foreign government, tracking some activities, and similarly, the foreign government help the U.S. government to track other activity for its citizens as well as people living outside of the U.S. Okay, libraries and bookstores. Provision related to the access of library and bookstore records were included in the original act, but were later modified to provide more protection for patrons' privacy. Interesting, right? Okay, number 7, sunsetting provision. Several provisions of the U.S. Patriot Act include sunset clauses, which mean that they would automatically expire after a certain period unless renewed by the Congress. These provisions underwent multiple reauthorization over the years. So, I don't know, what did we say yesterday regarding some extension to I forgot, but do you remember yesterday I said if it's past 2019 and then 2021 they would have to renew it. So it's part of the sunsetting provision. So meaning that this USA Patriot Act have a certain limit time, right? And then when the time reach, they will resubmit it to extend it to to cover the later years. Okay. Okay, USA Patriot Act is the purpose of this is to deter and punish terrorist acts in the U.S. and around the world, and also to enhance the law enforcement investigation tools and other purposes, some of which include, one of which, to strengthen U.S. measure to prevent, detect, and prosecute international money laundering and financing of terrorism. right? When they say that they want to prevent money laundering and financial terrorism, right? Sometimes if they caught any illegal activity or activity that doesn't meet with the U.S. law, they will prosecute that person too. Okay, not only for terrorism, because this law is in place, right? They want to know where the money coming from, right? They want to see how you use the money. So now everything we do need to be legal, need to be within the framework of the law. It's also the subject to specific scrutiny foreign jurisdiction, foreign financial institution, and classes of international transactional or type of account that are susceptible to criminal abuse. So like I say, it's also go after, big corporation, big businesses, financial institution across the world. Okay, so like I say, this act is not only for checking terrorism, but also a wider range. To require all appropriate elements of the financial services industry to report potential money laundering, the SAR, right? I just mentioned that earlier, right? The financial banking need to, report the, suspicious activity, which is providing a SAR report. All right, to strengthen measure to prevent the use of the U.S. financial system for personal gain by corrupt foreign official, right? And facilitate repatriation of stolen asset of citizens of country to whom such assets belong. Okay, so they say, they try to prevent corruption. Okay, and then if any illegal activity, they want to be able to return the stolen asset back to the to the owner. Okay, next to last law, Mortgage Assistant Relief Services, MARS. Who want to go to Mars? Right? What is Mars? Mars is a Mortgage Assistant Relief Services. Okay, so we find out what it is. So it's mainly a help, an assistance due to the 2008 market meltdown, housing meltdown, right? There are more services, more help for the consumer. Okay, so MARS refer to a category of services offered by company or individuals that claim to assist the homeowners facing financial distress and difficulty in making mortgage payments. These services typically target homeowners who are at risk of foreclosure, often due to mortgage delinquency or financial hardship. MARS providers claim to help these homeowners modify their mortgage terms, negotiate with the lenders, or otherwise obtain relief from foreclosure. So there's a lot of bad people out there, right? They say, hey, I know that you're about to get foreclosure. Let me help you, right? Let's pay me a fee, and I'll have you, work with your lender and blah blah blah, to get you through this, hardship. But eventually, they collect the fee and they disappear, right? So this law, MARS, it's come out to prevent that from happening, and that was what happening right after 2008, right? A lot of people got foreclosure, and then these scammers, like they attack people while the owners already struggle, right? So this law came out on 2010, Regulation O, right, to help facilitate preventing this issue. So FTC implement rules and regulations to address this issue and protect consumer from fraudulent MARS providers. MARS rules, commonly referred to as MARS rule. I'm sorry. The Mortgage Assistant Relief Services rule, commonly referred to as MARS rule, was issued in 2010 and including provision to prevent deceptive practices. Okay, bad people, deceptive marketing, deceptive telemarketing, right, and all that. And the MARS rule have a couple components. First, advance fee prohibition, meaning that you don't pay until you get what you deserve, or shouldn't say deserve, what you get help for. Okay, you need to see a solution first before you pay a fee. So this MARS prevent the advance fee prohibition. It prevent a consumer from paying a fee before seeing a result. Okay. So what is explained as under the March rule, providers of mortgage assistance relief services are generally prohibited from collecting fees in advance of providing a promised services, right? Charging fees upfront was a common tactic used by fraudulent providers, right? They just want to collect fee. They don't want, they're not sure that they're going to able to help, right? So this March rule prevent that from happening. Disclosure. Most providers are required to provide homeowners with clear and specific disclosure about their services. Okay, what do? You say you help me, but what do you do? Right? You need to disclose all the steps, all the things that you're going to help, right? And also including a likelihood of success. So similarly to like a credit repair, right? With the credit repair, you only pay after you see a success or some improvement, right? So that's one of the examples where you don't pay an upfront fee until you see the result. The cost involved and the fact that the homeowner can attempt to negotiate with their lender on their own, right? The Mars provider can say, hey, we can help you guys, but you can also do yourself. I disclose to you. If you're able to do yourself, you can negotiate with the lenders. Go ahead and do it. If you cannot, we're here to help. But we help you once we get the result and we get paid. Okay, number 3, prohibited misrepresentations. The rule prohibits deceptive and misleading statements in advertising, representation made by the Mars provider to homeowner. Providers cannot make false claims about their success rate or guarantee a specific outcome, right? So meaning that any provider, back to that credit repair company, okay? You cannot say that, oh, we like help thousands of people with a success rate of 95%, okay? You cannot claim that, right? You just say, okay, we will try to help you, right? So all the marketing material, all the representation material, right, need not to be deceptive, right? Record keeping. Most provider must maintain records of their interaction with homeowners for compliance and enforcement purposes, right? All right, the Marsh rule was implementing protecting homeowners from being victimized by unscrupulous individuals and companies offering fraudulent mortgage assistance services. Okay, homeowners facing mortgage difficulties are encouraged to exercise caution when seeking assistance and to be wary of any service that require upfront fee. Be careful, right? Make any service that make unrealistic promises or use high pressure sales tactics. Okay, let's continue. Homeowners facing foreclosure are often desperate for a way to hold on their home. Some companies claim they can help fight off foreclosure by negotiating new mortgage terms with the lenders or the servicers. So you remember, right? You borrow money from a lender, but the one that helped you make payment is called servicers. Okay, and sometimes the servicer can be a third-party company, or the servicer can be a department within the lender. Okay, keep in mind that the difference between lenders and servicers. FTC, the Nation Consumer Protection Agency, has issued a rule to curb unfair and deceptive practices associated with mortgage assistance relief services. Okay, if you offer a mortgage assistance relief service or work with a company that do is wise to know about the provision of the Marsh rule. Okay, so we already talked about some of this. Illegal charge upfront fees. You must tell them upfront key information about your services. So this part right here is talking about you as an MLO, right? If you provide any service, right, you need to abide to the Marsh rule. Right, you cannot overpromise. You cannot say, "I'll guarantee you that you're going to get the 4.5%," right? Or I guarantee you like a no cost, no fee. Right? Don't guarantee, because like things can change. Right? This rule right here applies to you as an MLO. right? You got to be careful how you talk, right? And you say, okay, I can provide you with this, with some disclosure, right? It depend on your credit score, your income, and other facts, right? Or your other information that you're going to provide, right? So don't overpromise. Don't provide it deceptive. Don't do like a bait and a switch, meaning that hey, we have you at 4.5, but eventually the borrower get a 5.5. It's called bait and switch, right? Okay, if you advise someone not to pay for his her mortgage, you must clearly and prominently disclose the negative consequences that could result. Okay, don't advise customer to stop communicating with their lender or servicer. Don't do that. Okay, don't tell your borrower, your client, your customer do a negative thing. Okay, it's illegal. You must disclose key information to your customer if you forward an offer of mortgage relief form a lender or servicer. Okay. Okay. So if you as an MLO and then you work with the a lender or a servicer of a lender, and they send you a document about the mortgage relief program, right? You need to disclose, say, this information is provided to me, that I provide to you by the lender that I work with. Okay, you have to disclose all that. You must give your customer a written notice from the lender or servicer describing all material differences between the terms and the offer and the customer current loan, right? So if you say that we can do what is it called, a loan modification, right? You're unable to pay, right? But we have a better program that we can help you to sustain based on your income. Okay, but I got this booklet, this package from the from the servicer or from the lender, right? These are, to my best knowledge, it's a good source, right? The term probably that is what they're offering for you. Okay, and then you just kind of provide with a written notice to the client. Okay, and like I say, don't misrepresent your service, right? Under the rule, it's illegal to make claims that are false, misleading, or unsustained. Okay, so meaning that like say whatever the loan product that you have, you focus on that. You don't first overpromise, or you don't marketing somebody else, loan product, because eventually you're probably not going to be able to get that product, right? Try to the hard part when you do, when you're engaging and helping the consumer is like you need to go on the right path. Okay, don't crisscross. Okay, and make illegal activities. So, and like I say, what is the next thing about the mortgage is the MAP advertising. Mortgage Act and practices in advertising called MAP advertising. This act was enacted in 2018, and it's a regulation. And what is MAP advertising? It's a regulation issued by the Consumer Financial Protection Bureau, CFPB, in the US. It is part of a broader framework of mortgage regulations aimed at ensuring fair and transparent practices in the mortgage industry. The MAP advertising rule specifically addresses advertising practices related to mortgages and home loans. So remember, right? The SAFE Act, HIPAA, ECOA, right? All of that, including Dodd-Frank Act, right? All of that, including non-deceptive marketing strategies. Okay, so the MAP here, the MAP advertising, or short by MAP advertising here, is also focused on that, right? It prohibit deceptive advertising. Okay, and you know what is meant by deceptive, right? Misleading or advertising practices by mortgage lender and advertiser. Advertisement related to mortgage loan must be accurate, clear, and not likely mislead consumers. Okay, MAP advertising set forth specific requirements for mortgage advertisement. These include disclosure essential loan terms, like what? What's the rate? What's the APR, what's the number of years, right? Payment, right? And any adjustment if there is if there's an arm rate or adjustable rate mortgage, and any balance information that allow consumer to understand the true cost and term of the mortgage. Let me see here. Okay. Let me scan up. Okay. So sometimes there's some triggers to the marketing. I probably mentioned this before. If anytime that you mention a number, anytime that you mention a term, right, you need to include the APR, the annual percentage rate. Okay, you can include the APR without the rate, it's fine. Okay, but anytime that you touch base with a number on your marketing, you need to include an APR, right? If you include an APR, you can include the loan amount, you can include the credit score, you can include the term, you can include the rate, right? But you must have an APR in it, right? So, and also when you do marketing, you need to include your name, your NMLS identification, right? So they know who they're talking to, and they know that the marketing material is coming from a legit licensed professional or mortgage loan originator. Okay, and also the map is also prohibit the misrepresentation. So all the rule, all the law that you have been heard, they all try to protect the consumer from misleading and deceptive practices. Okay, record keeping. Maps also require some good record keeping as well, right? Mortgage lender and advertiser must maintain record their advertisement for a specific period, allowing regulatory authority to assess compliance and investigate potential violation. If I not mistaken, for the ad for the marketing material, you have to keep it for 2 years. So if you post an ad on Facebook, post an ad on through email, print out, anything like that, you need to keep the original for 2 years. It's a tough one to do. Okay, it's not easy. Okay, but by law you need to keep that. So be careful what you're marketing out there. Sometimes it's not just like a Facebook post; it's a marketing. But sometimes that you're answering, and you're answering a post, you put a comment in there, and maybe you drop in a little, business card or some wording about the rate, APR, and all that. That also consider a marketing as well, and you need to keep a record of that. And imagine that nowadays that you interact with like so many different social media groups and platforms, and you post so many stuff online. How are you going to be able to keep all that records for 2 years, right? So got to be careful. Enforcement, the MAP enforcement. CFPB has the authority to enforce the MAP advertising rule and take action against the lenders and advertisers found to be engaging in deceptive advertising practices. Violators may face fines, penalties, and other regulatory actions, including potentially prison if you do in something fraudulent. Okay, so MAP is a regulation N because it regulates how mortgage lender, servicer, broker, advertising agency, and other can advertise the mortgage services, right, in the right way. FTC enforces complying with the Credit Card Accountability and Responsibility to Disclosure Act of 2009, Card Act, and the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, Dodd-Frank Act. Okay, so this regulation N is in play with those two acts as well. The rule forbid deceptive claim in mortgage advertising and other commercial communication sent to consumer by these entities. Okay. So now let me give you an example of what is mean by a deceptive. Okay, and I just explained it earlier, but kind of read through this example right now. Example of deceptive claims including advertising a low fixed rate without specifying that same rate is applicable only for a very brief introductory period, right? You say, hey, I offer a low fixed rate for 30 years. but you didn't say that how long, how long that rate gonna last. Is it last for 30 years? Is it last for 5 years, 7 years? This also mentioned like, sometimes that the credit card company, right? They marketing a material, a rate, right? And they didn't say that, this rate gonna be expire after 18 months. They didn't say this rate gonna be expire after 12 months, right? Sometimes you get a credit card, 0%, but guess what? After 12 months, you're gonna pay 15%, 21%, right? Those are deceptive if you don't disclaim that, you don't disclosure that. Okay. Payment rate with interest rate. Okay. Alternatively, a lender could fail to let the consumer know that payment rates may not cover the interest due each month. So sometime that, probably in the past, okay, there may be a bank that, that say that, hey, you borrow our loan and you pay this amount, but they omit the amount of the interest that they add on. So the total amount may not reflect the actual payment, and eventually that's going to be a negative amortization. Okay, meaning that the more, even that you keep make payment, but your balance keep growing. Okay, because you didn't take into account of the interest. Okay, leading to a negative amortization, right? I just explained it. A situation in which the loan amount increase over time because the monthly unpaid interest is being added to the principal amount. Okay, deceptive mortgage advertisement might also fail to discuss significant loan terms or imply that the mortgage lender in question is affiliated with any government agency when they are not. So for this one, for example, right, sometimes you receive a mail, right? And when you open that mail, you probably see a VA logo on it. You may see FHA logo on it. You may see a big marketing VA program, right? And then they may have, so many words, phone number, addresses, a name, official logo of VA or FHA, right? Those are deceptive if they are not from VA. Okay, so meaning that someone illegally using the logo from this entity, government entity, put on their letter and marketing that material or product to you. Okay, and that is deceptive. And they are not affiliated with the government agency. They not work for the government agency. And when they do that, they are engaged in illegal activity. Okay, last slide. The nature, the amount of existing consumer fees associated with the mortgage product. Okay, so you need to let me see, the type of the mortgage offer, right? Anything that you marketing need to be correct. Okay, the term, the payment amount, other requirement of a mortgage agreement, include those related to insurance and taxes. Let me see if there's any variable interest rate, variable payment amount, term length going to change, other mortgage terms, right? Percentage of a monthly payment will go to principal, go to interest, right? Things like that, can be included too. And also the total amount due, right? Likelihood of the consumer to refinance or modify the mortgage or its term. Okay, so all this kind of stuff. If you ask a consumer go to, borrow a loan, guess what? At the end of the escrow closure, you're gonna sign like a couple hundred pages document, and all this stuff is actually in there. Nowadays, it's required that need to be disclosed, need to be clear, right? And guess what? I don't think anybody have time to read all that, but you should if you receive that, as a consumer. Okay, any prepayment penalty, any potential for the default, and what are the circumstances if you get default? The right of consumer reside dwelling being purchased. Okay, meaning that the right of the consumer reside and the dwelling being purchased, like either you are primary owner or as a rental property. Nature, substance, availability of any expert advice. So all these things, okay, including counseling services, a booklet that I think we're going to go over that within the classes that including the MLO activities, that all the booklets, hazard, natural hazard booklet, and all that need to be provided, to the consumer. Okay, the source of commercial communication or advertisement regarding mortgage product. Okay, so if you advertise a product, okay, is that product from your broker? Is that product from a lender? Right, it need to be, it need to be correct. Right, you cannot, like I said, you cannot market somebody else product, because like eventually it's more like a bait and switch. Okay, so got to be careful on that one. So I know I'm a little bit running over, but I'm gladly that I go over all the laws with you. Okay, so the next two classes we're gonna focus on the fun stuff and put behind our back with these laws. But I will go over this like within the activity too. So kind of mapping how the activities related to the law and how the law enforce the activities. Okay, so thank you. Anybody have any questions?
Yeah.
No question.
I'm still thinking about how to get the first client.
How to get the first client?
Yeah.
Oh man,
that's
you should focus on how to pass the test.
actually, yeah, I passed that in 2020, so I passed the exam in 2020. I just submitted the application for the license yesterday. Yeah, and waiting for the response.
Nice. So like I say, getting your first customer, I don't think it's hard. If you pick your family, for example, your friends, for example, right, or your coworker, for example, focus on that, right? I guarantee you can find at least one client from there. Okay, so your family, they may, if they already purchased a home, probably they're not gonna refinance anytime soon. The reason being is that they may already lock in a historically low rate possible, right? So they're not gonna refinance soon, but they may take some HELOC. Okay, they say, okay, I have a lot of equity in my home. Now I want to buy the next home, an investment property, for example, right? And now you can help them with the HELOC, right? Get the HELOC open and get some cash out for the home, right? And then guess what? That's your first transaction right there. But now they get the cash out, they're gonna use that money to go buy another property. That's your second transaction right there, right? Focus on your close circle first, including friends, family, and coworkers. Okay, and then next step, you go online, you go social media, you go Facebook, right? You follow those mortgage and real estate groups, and people are gonna ask for help, and then you're gonna marketing your service with them, and then eventually you're gonna get more clients. Once you get the first few clients, guess what? You're gonna get referral, and then you're gonna get more clients from there. Okay, so like don't worry about your first client. You can also partner with a realtor, right? Then partner with a realtor, definitely you're gonna get at least several clients with that one realtor. And then if you partner with so many realtors, there you go. You have a lot of clients that you can work with. Okay, hopefully that gives you some
thank you, Mark.
some good advice. Okay, rồi Thảo, em có question gì không? How is it? No? Good? Okay. So if not, I will see you everybody tomorrow at 8. Okay, for more fun stuff. Okay, now we're gonna put the all the laws behind us, but we're gonna focus on the real activity of the MLO. Okay, right. Have a good night, everybody.
Thank you.
Bye bye.